Good afternoon, morning, evening, and welcome to today's session of Emergence Global. I'm Hugo Dupont, and I'll be your host for today's session. This marks our 15th session, and exactly 1 month since we've launched, we have another full month of presentations, panels, etc. For today's session, however, we have a very exciting lineup. First, we will start off with a pitch presentation from Terabios. We then have the privilege of welcoming 4 investment experts on our early stage investment panel. Before we proceed, I do want to mention that if you are already using the CRIISP platform, please make sure to head on over to our networking/exhibitor zone to network with any of the founders or investors. So without further ado, I'd like to welcome Esat Oguz, the CEO of Terabios, to present his company. Terabios are a biomedical company focused on developing blood coagulation monitoring/diagnostic systems in the aim of improving the efficiency of healthcare professionals and patients' quality of life.
Thanks, Hugo. So, hello, everyone. I am Esat Oguz, CEO at Terabios. As Hugo mentioned, we are a biomedical company focused on developing coagulation monitoring and diagnostic systems with a point-of-care and self-testing PT-INR coagulometer. Why is PT-INR coagulometer needed? Because the oral anticoagulant therapy is vital for the patients with cardiovascular issues, but assessing individual patient response to warfarin can be challenging due to various factors such as age, disease state, dietary, and medication interactions. So, regular laboratory monitoring and dose adjustments are essential to avoid complications such as excessive bleeding or increased risk of thrombotic events. So, how are those monitoring done right now? Standard reference is hospitals. The routine laboratory monitoring requires patients to visit the hospital, draw large quantities of blood, and wait at least an hour for results. This is why, as Terabios, we believe that improving the efficiency of healthcare professionals and patients' quality of life is a must. For that purpose, we developed CRIISP, a portable blood coagulation monitoring platform to produce lab-equivalent results. Our patented system is based on a unique optomechanical measurement principle using microfluidic and lab-on-a-chip technology. CRIISP has a compact design that requires a low-volume blood sample from a finger prick, provides rapid results within minutes, and integrates a multi-level quality control system. CRIISP is composed of a reader and a disposable cartridge. From just 1 drop of blood, our cartridge uses the passive capillary flow to fill the microfluidic system. And the device can be used in a clinical setting, doctor's office, or at home, providing patients with convenience and flexibility. And the direct measurement principle, based on viscoelasticity variation, makes it more advantageous than other electrochemical-based point-of-care coagulation devices, as measurements are not affected by drug-drug interactions or other clinical symptoms. So after we release the CRIISP product, we will aim to introduce a mobile application allowing remote and direct communication with healthcare professionals. And the last thing that I would like to mention in this slide is we have 2 patent portfolios granted in several European countries and US as well. Our milestones. Firstly, we will gonna move our headquarters to the Netherlands within Q3 2023. In the right-hand side, you see the awards taken from reputable entities. For example, we were selected as one of the top 12 startup companies in Medica. We will finalize our technical documentation and apply for CE marking at the end of this year for CRIISP, our PT-INR coagulometer, aiming to launch our product in the market in the very beginning of second half of next year. And we will firstly introduce our products to hospitals and clinics in Europe. And this will be followed by self-testing in the following year. And after getting the CE mark, we will start FDA clearance process for the US market. The coagulation monitoring market is the second largest market after glucose testing, with an expected 11% of CAGR growth and projected to reach $2 billion in 2027. So it's a very sizable market. There are several reasons for this growth. The main one is the growing demand for preventive medical care. The CRIISP system has a compact and user-friendly design that requires a low-volume blood sample from a finger prick, as I have mentioned before, and providing rapid results within minutes, and integrates a multi-level quality control system. Our patented optomechanical measurement principle is a viscosity-based approach, offering gold standard accuracy and precision. And also it is less susceptible to drug interactions and clinical symptoms. Trabios is not only working for the blood coagulation environment, Trabios is expanding its research and application fields to the other areas as well. And with the goal of developing a multi-parametric handheld point-of-care coagulation device, we will be able to monitor all coagulation parameters. And later on, we're going to use this innovative technology for optimization, versatility, and the application in various research fields, including the detection, monitoring of viral infections and inflammatory diseases as well, and also viscosity measurement of industrial and agricultural fluids. Trabios PT-INR monitoring system for point-of-care and self-care use only offers remote monitoring capabilities via Bluetooth and a mobile application as well. After launching the initial PT-INR products, we will complete the range of coagulation tests by adding APTT, ACT, and NOAC-DOACs monitoring parameters. We will then focus to develop novel and potentially groundbreaking diagnostic applications in the medical, environmental, and also industrial fields. We have a very capable top management team. I'm working as a CEO of this company. I have more than 15 years of healthcare industry experience. I have worked in top management roles, both in Pfizer Pharmaceuticals and Reckitt Benckiser as well, which are the pharma and FMCG global giants. And my former previous job in Reckitt Benckiser, I'm really proud of creating the healthcare business from scratch. Our founder and also CSO, Professor Dr. Hakan Ürey, he's a serial entrepreneur with over 50 patents, 5 spin-offs, and he made one exit as well. And he has the ERC Advanced Grant as well. And he has the PhD from Electrical Engineering from Georgia Tech University. Last but not least, our Technology and Product Development Manager, Dr. Sinan Müldür, has his postdoc at Harvard Medical School. The subject was related, the research was related with the all blood microfluidics for viral and inflammatory diseases diagnostics. And he has a scientific and technical officer. He has a duty of scientific and technical officer at the Institute for Health and Consumer Protection. So this is the end of my presentation. We'll be deeply interested for new investors and partnerships in this sector, and happy to discuss more if you send me an email, if you reach me via the CRIISP platform or call me. Thanks a lot.
Thank you very much, Esat. Yeah, thank you very much. As Esat said, if you're joining us from the CRIISP platform, please make sure to connect with him directly via the networking zone. If you're joining us from YouTube, please find the link in the description to join us for free and have the possibility to network with thousands of attendees and to connect with the founders making a difference. We will be back in just a moment with our early stage investment panel. So thank you and welcome back to today's Emergence Global session. I'm very excited to welcome you to our early stage investment panel this afternoon. And we're joined by four amazing people. Pauline Lee from Madonna Capital, Andrew Zinchuk from ZAS Ventures, Sam Marchant from Hambro Perks, and Jeremy Luzinda from Hatch VC. Welcome all.
Hey, thank you for having us.
Thank you. Thanks for having us.
There you go. Thanks for having us.
Thanks. So would you each like to introduce yourself? Perhaps Pauline, you could go first.
Sure. Hi, everyone. My name is Pauline Lee. I'm a managing partner at Madonna Capital. Madonna Capital are growth partners to high growth businesses with a fair female representation in the C-suite. And what we do is we help our clients get investor ready. Then we introduce them to relevant investors who have expressed interest in knowing more, and then we help them fundraise in that regard. We also offer bespoke growth consulting, and that really speaks to our various backgrounds. My background is I'm a fractional CFO. I'm a chartered accountant who started at KPMG in consulting. Then I had various roles operationally in various industries, including media, construction, oil and gas, and then my niche is now in luxury consumer.
Thank you very much.
Thanks for having me.
Thanks. Sam, if you'd like to go next.
For sure. Yeah, good afternoon, everyone. Thank you, Hugo, for putting this on and for inviting me on. So my name is Sam Marchant. I'm an investment associate here on the team at Hambro Perks. We span quite a wide range of different stages now. So we invest from kind of pre-seed all the way up to Series B, Series C. We also have secondaries funds and kind of special opportunities funds. I primarily look after the early stage investment pot of capital that we have here at HB. So typically pre-seed, seed, investing kind of 500k checks into four key verticals. So fintech, insurtech, digital health, sustainability, and then future of work and education. So yeah, previously I was at Ascension Ventures for a bit, and then prior to that I was a founder as well. So built and scaled an FMCG business. So have the battle scars to show for it.
Fantastic, and thanks for coming back. You were actually our first session of Global. We've actually just reached the halfway mark, and still one more month to go.
Impressive.
Yeah. Jeremy, please.
Sure, let me know if you can hear me clearly. My connection's been a bit unstable today.
You're all good.
Perfect. So hey guys, I'm Jeremy Luzinda. I'm a principal at Hatch. Hatch is an early stage fund. We invest at pre-seed, mainly in B2B SaaS, solving deep problems or creating massive impact for organizations. I guess myself, I'm a previous founder, raised VC cash. Ultimately, the business wasn't that successful. Following that, I became a managing director at an energy software business. We'd raised about £10 million, some venture capital, some grant money. Unfortunately, that didn't work out. Following that, I became an investor at Playfair, worked on some exciting deals, namely Omnipresent, which we saw go from zero to a soonicorn, if you want to call it that, in under 18 months. And then following that, I joined Hatch, where I manage our SCIS and EIS funds, as well as also lead our deployment and investment strategy across all our funds.
Brilliant. Thank you, Jeremy. And last but not least, Andrew.
Yeah, thanks. Great to be here. Yeah, so I'm founder and managing partner at ZAS Ventures. So we are early stage fund between San Francisco and Kiev. So we invest in mostly pre-seed, seed stage startups from Eastern Europe that target the US market. That's our niche. So we mostly B2B, but sometimes also do B2C stuff and pretty much industry agnostic. As to myself, I'm entrepreneur turned VC. Was also have a deep operator background, managing the startup incubator pre-team, pre-idea. Also was with Israeli family fund. And basically, as an entrepreneur, I had a couple of my startups, and then in the end of the day, turned back to VC to help guys not to make my mistakes and save years of life and pain.
And that's thanks, and that's why we're here today, right? So early stage investment panel to get some insights from you guys on how they can avoid those mistakes. So let's just jump straight into it. And I guess Sam, coming to you first. The startup and investment landscape has evolved significantly over the last decade. How do you distinguish yourselves? How can startups distinguish themselves in an increasingly crowded market?
Really interesting question. From the perspective of a venture capitalist, or from the perspective of just building a good business?
I guess both could be a good place to start.
Yeah. Okay. I mean, I think that I will caveat this whole thing by saying not every business is suitable for venture capital. So once we kind of agree that that's a precedent, then we can kind of move forward from there. In terms of making yourselves differentiated or kind of stand alone in this market, from a VC perspective, it is about solving, as Jeremy kind of alluded to, deep problems, big problems, real big jumps in innovation, rather than the kind of that classic Peter Thiel thing of just moving the needle from 0 to 0.2 or 0.5. The world has a number of big problems that entrepreneurs and founders can tackle, and I think really being able to differentiate yourself by providing a deep level of innovation or going after something that is truly massive that you feel you can tackle. That is for VC, right? In terms of just building a good business that you could exit for 5 to 20 million, it's about bringing value to people, right? It's always about bringing value and inspiring increase, and that's one thing I found as being a founder is identifying a niche, really looking to serve that niche, spending a lot of time with the people in that niche, understanding what they want, and then just delivering value to them in a place and in a way that they really wanted it or they felt they couldn't actually attain themselves. That was how we were able to differentiate ourselves in what was a very crowded market from an FMCG space. So I think it's hard. I think it's very hard to hear. I have a lot of conversations with a lot of founders who think that they're think that they're differentiating themselves in the market, and actually what they're doing is just trying to fit a VC mold, which isn't necessarily the right thing for them in their markets or in their sectors or categories. So those would be my thoughts on that topic. Maybe a bit contrarian, I don't know. I don't know, but Andrew, Jeremy, Pauline might agree, might disagree, but that's why we're here.
Fantastic. And I guess thanks, Sam. Pauline, Jeremy, Andrew, do you agree? Do you disagree with what Sam has said?
Yeah, I mean, I agree in terms of, our clients and how we select our clients. So we looked at venture backable businesses mostly, and I have to agree with Sam in terms of solving that problem or the level of innovation. So first of all, are you the right person to solve that problem? Is that problem so big and that pain point so huge that it would be a very huge market for you to tackle? And then is your product so innovative that it is basically 100 times better than what's currently out there, or it's completely new? Otherwise there is still a place for your business, but just not necessarily in the venture space.
Right, fantastic. And I guess coming on to you, Andrew, in a similar question, right? Obviously, the war in Ukraine has been going for more than a year now. How have you felt the startup landscape has changed? And if you could provide some insight into that.
Sure. I mean, it was a hell of a year. I was also caught here. It was the war, and I'm still in Ukraine, right? So I feel everything with my skin. But in terms of the ecosystem, it was a big shock for everyone here because, first of all, it's still founders, it's lives, right? So you have to protect your life before you can do everything. And with the beginning of the war, it was a big shock here. Everyone was trying to relocate to the West. No one was expecting what to do, how to overcome, because we had a lot of power shortages. And the teams actually managed to survive and even thrive. So thanks to Starlinks, we could get, in one of the moment you have airstrike alarm, and then you still kind of working in the corridor or just between two walls. So people kind of, manage to get over the circumstances and keep going, which is super important. And most of the startups which we see is actually haven't closed the business. So they still kind of, even those who had the local market here, they managed to kind of find some deals and find new clients like in EU market or in US market. And that's actually, we're doing a special fund for those kind of startups, because the problem with the local market and ecosystem is that with the beginning of the war, like there is no early stage investor right now, because angels, most of the people just donating money to the army or have like business problems, because those who are actually deep with the deep pockets, they suffer like business losses. So usually people just trying to kind of help their business to kind of survive, right? And now there is like this gap with the money, and the only one who was like the biggest investor here on the early stage was so-called Ukrainian Startup Fund, which was a government-backed and world-backed fund, which was giving like 25 to 50K grants equity-free on pre-seed and seed stage. And even those guys, they gave away all of that money to the army. So like there was literally no one kind of to support the startups. And I was talking to, like last year, I managed to speak to 250 startups. And basically we filter out those who get early traction. And the guys who had this traction in Ukraine, they lost it and managed to get this early traction back in like EU market and US market. And problems with them is that, hey, they kind of survive, right? That's actually what you look for in the founders, the guys who could survive in any circumstances. But the problem with them is, or their problem is that, hey, they have this early traction and it's not there. If you would talk to like typical VC and, to be qualified for the investment. It's on the one hand side. And even though some of them might have this traction, the problem is for them that if you have a core team, all of the VCs saying like, hey, like it's nice, but they just declining. And there is exceptions, of course, when the teams are actually managed to get out of Ukraine, or there is like a part of the team which has a female founders, and they managed to move out. So that's kind of negotiated. But VCs will be, and it's a good time for actually to invest, because for like if you are up to that risk as a VC, so it's a very good time because valuations even lower than before. But that's actually can give a good hand to those startups with your cash and with the support and with kind of advice. So now we're focusing on this kind of startups, and we will be doing like 30 deals in the next 2 years. And we found some really amazing startups that did it from scratch. As an example, I have a guy. He was in my incubation program back in the day when I was managing it, and he ended up in Chernihiv, sitting in a basement for 1 month because the city was surrounded with Russians. And once he got out from basement, he actually managed to raise 250K, and that's the type of resilience I'm talking about. So there is like a lot of these super cool stories where people like doing startups, even some of them went and joined military to protect, but still kind of keep going. So there is a lot of going on, but I don't want to take away all of the time. Maybe we're gonna do some special thing on this.
Fantastic. Thank you very much, Andrew, for that. Now coming on to you, probably Jeremy. With Hatch's SEIS and EIS fund, you guys must see a lot of early stage founders, right? What do you think makes a great founder? And I understand that this is probably one of the most open-ended questions, so I don't expect you to cover the entire thing. But if you could provide maybe a few, characteristics that makes a great founder. I guess Andrew talked about resilience, but if you could provide maybe a few more that you've seen.
It's a big question. I think. I mean, I'll caveat everything I say by saying that my answer is limited by what I've been exposed to. Of the entrepreneurs that I've seen now, Hatch is made up of entrepreneurs. Scott, once upon a time, built a business called Kitty Care, which he sold for Morrison's for 70 million. Simon built an agency which he sold for 37 million. These are all partners at Hatch, and they were all successful. Resilience is definitely one. I think at Hatch, something that we look out for and is it's founders that are really willing to risk it all for that goal. It's the only thing that they're focused on. I mean, of course, within reason, there are like wider things which you have to take into account, like your health, of course. But really, I think resilience is the big one. Scott, when he was 18, was kicked out of his house, went through several failures, almost got a divorce, was almost bankrupt, did go bankrupt, but eventually managed to turn it all around and ended up selling his business for 70 million. So that level of resilience is always something that we look for, but also people that are just willing to just test it. You don't need a working product or a fully fledged product for you to prove that this is valuable. You can start a Facebook group, you can reach out to people. I mean, there are so many different things that you can prove out, but if you're able to distill, I guess, the core components of your product down to its like the core bits that drive the most value, a lot of the time you don't need a fancy UI to prove that the concept works. And that's what we look for, because again, going back to our founding story around Scott, around Fred, around Simon, who were all entrepreneurs who went through different challenges, who unlike the companies that we see, weren't VC backed, didn't have a huge bank account to go off and build from. They had to grow off of generating value immediately. So I think resilience, being able to prove that you can prove value immediately, and then also I think being a good communicator is important. I have a mentor stroke friend who's a partner at a multi-billion-pound fund. He's been investing for more than 13 years. And I asked him, from his perspective, what are the main responsibilities of a founder, stroke CEO? And he said, well, actually, at the start, it really all comes down to storytelling. You have two responsibilities. One is to hire the best talent and retain them. And then the other is to make sure there's enough money in the business to enable that great talent to keep on building. And both of those require great storytelling. You need great storytelling to hire the best talent and retain them, but then also great storytelling in order to raise subsequent rounds from VCs. So yeah, I'd say strong communicator, resilience, and then lastly, just being able to just get your hands dirty and just prove something without all the lights, the flashing lights, the bells, the whistles, etc.
Fantastic. Thanks. Pauline, Sam, do you guys have any other traits that you've seen in great founders that maybe Jeremy hasn't touched upon, or has he covered the whole characteristics?
I think there's an endless list, right? And as Jeremy said, it really depends on your personal experience and what kind of successes have come out of the founders that you've interacted with. And sometimes you can have success because of luck, but within that luck, you have to be ready to take take advantage of the situation. In terms of founders that I've worked with who have been successful and whom I really enjoy working with, we really look at the responsiveness and the level of accountability. So it could be accountability towards themselves, towards investors, just various stakeholders and the employers as well. So for example, when we're looking to onboard a client throughout a selection process, one thing that we observe is how responsive they are in terms of the questions that we would send to them, how quickly they take on feedback or how well they take on feedback. And if they do decide to take on feedback, why they take it on, why they don't take it on. So just being totally accountable to for their own product and for their actions and their words. I think that makes a successful founder.
Fantastic. Sam, I think, did you want to say something?
I guess the only thing I would add, if I could add anything, I think there's as Pauline said, it can go on this list forever. We really like founders with a high degree of self-awareness, those who know their strengths and those who know their weaknesses as well. Not because a weakness may impact our investment decision, but actually because a weakness is an area that we can help, we can support on. And I think if you know your blind spots, that's where you build a good team around you. So yeah, self-awareness is the only one I'd throw in.
Great, thanks. I guess staying on to you, Sam. At Hambro Perks, how do you evaluate the IP of an early stage startup?
That's a really specific question. Okay, right. Well, all cards on the table. Because HP spans everything from early stage all the way up to growth. We actually have internal legal, which is quite a nice quite a nice little thing to have. So for us, it goes back to everything. So understanding the basics. What is patentable? Is there a patent? Has a company gone down that process? IP is a tricky one because I think it's something that in the early stages founders can often get hung up on. And I think Jeremy's already stressed the importance of just going out, building, testing, and kind of working on these incremental steps. When you get to scale, maybe at that kind of seed to even Series A, Series B, that's where you're really turning on the IP tap. So for us, in this specific instance, it's making sure that everything is watertight. So if there are patents, they're there. Are they cross-border? Are they international patents, or are they just kind of for a single location? And then also understanding, and this is something that is often overlooked with IP, understanding the founder's views on enforcing that IP. It's something that often goes misunderstood, which is if you have a patent and someone abuses it, you have to take them to court and you have to typically pay out a fair amount to actually try and see that all the way through. Sometimes this is a good use of capital. Sometimes this is a bad use of capital. I, as a founder, we pivoted our business quite heavily towards licensing. So read into that at an extensive level and kind of deemed it that actually if someone was ever going to try and copy us or build something like that, actually just having speed and building a big community and going brand first was a better use of our time and resources than actually trying to take someone to court. So a little bit of a long-winded answer there, but we kind of sit with a really nice position actually where our internal legal team are amazing, so they do a hell of a lot more work, as you can probably tell from my answer, than I do. But I think it's about having a clear structured approach and also just understanding where the business is at and the stage at which it's at, and the kind of level of IP that you need.
Okay, great, thanks. And now coming maybe back to a more general discussion, and maybe Andrew, you can go first on this one. What are some red flags that would cause you or ZAS Ventures to pass on an early stage investment opportunity?
Yeah, good one. I mean, there can be a lot of red flags, but for me, like early stage is about team, to be honest. And I've seen a lot of examples when kind of story fall apart just because of the team. One of the examples, we had a team in Minsk, and they had it was 2 years ago when they have elections of the president, and half of the team was pro Lukashenko, another was pro Tikhanovskaya. And it screwed the entire team, like in the entire startup. So literally, we lost the money there because like the team fall apart. But so for me, is like what I've learned, like hard way, that early stage is all about the team, the founders, and you have to look. It's not something you can track on paper, right? Like the resumes instead, but how much shit they ate together, right? What they gone through. Like, are they gonna stick? How can they make out of the fight? Because there is going to be a lot of fights down the road. Which way to go? If to pivot or not to pivot, if to take the offer, and there's a lot of things coming out and for the founders, like the entire team has to have the capacity to go through some period of time, because okay, maybe you have free money you was just raising, and how long can you sustain this? You can still sustain yourself. Then if you raise money, it doesn't mean you're going to raise sufficiently enough, to cover everything you need, right? So you still have to, as a founder, you have to suffer. That's your life, right? Because you're going to pay yourself less, but you build in the equity, and you have to hire more people to grow faster. So you have to dedicate money. So can you make this sacrifice? So for me, this is like super important. And when I look, usually when you ask what's going to be the proceed of funds, and when the founder gives, this is going to be a payroll. And I see if this is like market level or above market level, this is like a huge red flag and no for me. So it should be like definitely below the market level. I'm not saying you don't have to pay yourself. Everyone has a story, right? But this is like the first one. Then how balanced is the team? And then in terms of the equity, if there is like 90% in one guy and the rest is 10%, it is also no go. All right, and it's not going to just be sustainable in the future. Again, how the decisions are made in the team is also important, and we can kind of drill down to this, because for me it's going to be like a separate. I usually take like 2 meetings with a team and trying to see how they work, how they make decisions, and why they take these decisions, right? So that's kind of the most important things for me.
Okay, great. Pauline? maybe?
Yeah, I think it depends on how early stage you're talking about. If you're talking about something like pre-seed or seed, definitely. I mean, in terms of the founders and the team, it's important throughout the entire life cycle of the business, right? But yeah, especially in a much earlier stage, it's very important for the reasons just that was raised. In terms of other red flags, sometimes I feel like the product could lack focus. So the founder is still trying to work out, okay, what is the problem, and then what is the solution around that. They're going to, different stakeholders to survey, which is great. At the same time, they are looking to build a product based on various stakeholders' opinions. And I think at the end of the day, as a founder, you have to make a decision as to what you want the product to look like. And you can pivot and you can, test by having a focus in terms of a product pipeline or different ways to test without, going too further down the road and then spending all that money on something that you'll just scrap at the end of the day. The other is an unrealistic expectation of a raise. So from my perspective, Madonna Capital, we don't write a check. So when we speak with founders, what is the actual expectation in terms of valuation, in terms of timeline, in terms of the types of investors that they want us to introduce them to? And then, I think mostly it's really around the timeline. I think, right now with the current market conditions, things are just taking longer. Investors are a bit more conservative when it comes to actually writing a check and then the process that leads to writing a check. So if they expect to raise, within 3 months, like a 10 million round, then that's probably something that we won't participate in.
Great, thank you. And Sam, I guess same question, but slight variation. Hamburg Perks works across, early stage, but also growth stage. Are there different red flags that you look for when you're looking at those different kinds of stage companies, or is it still quite the same across both?
Yeah, I think it's a good question. I think as the sort of the earlier stages, often it's the two. There are a number of things, as with all of these things, but one of the biggest things that we look for, especially the early stage, is just the speed of execution. Can this individual, can this team actually get stuff done? Can they get what they say they're going to do on a model or a deck, which is very easy to put down? Oh, we're going to achieve X in Y time. Can they actually go away and do that? And a good indicator of that is typically what they've done to date. I find that the best founders, the ones who are scrappy, have built early, again reiterating Jeremy's point earlier, have gone away and done what they can and really stretched themselves to kind of prove that there is something there before kind of coming to market. So that's a flag for us, and that's definitely a consideration, especially at the early stage. As we go later stage, simply put, you have more data points, right? You have more data on the business, and you know what works. You also know what doesn't work, which often kind of helps you squash other competitors or other entrants into that market. And at that point, you then transition the business from being, founder-led sales, founder-led hiring, to, founder-led building, to actually, okay, teams are starting to grow. How can we look at culture? How do we instill this willingness to continue to drive forward? As the rounds get larger and larger, there can often be, I don't want to use the term complacency. I think that's probably a bit extreme here, but people can slow down and say, okay, I've got this big pile of gold, I'm going to sit on it. So how do you keep those founders thinking in that really scrappy mindset and executing really fast with the teams that they've got? What we find is that there's a transition point usually around seed Series A, where early stage founders tend to start hiring people who are more experienced in sectors than them, and often are with experience comes age. And if you're investing in younger founders, we find that they can often struggle hiring someone who's much older than them, sometimes even double their age, and actually helping those founders go through that process and build out the teams and the cultures that they want and also are conducive to success is really key. So yeah, I think you're always looking at teams in how they're going to adapt and how can they grow with the company. But it's a dynamic process, and I think it's something that most VCs, most VCs have chosen to go down this verticalized route. But actually, I think some of the best funds and the funds that really win are the stage-specific funds. Like I'm lucky enough to have dealt with Jeremy before, and seen the SEIS investments and the way that Hatch works, and the companies that kind of come through that pipeline are excellent, right? And they're set up in a certain way, they're structured, ready to roll on to the next round. I would then hope that people downstream say the same thing about Hambro Perks, right? Which is that that kind of seed to Series A space, we can help position founders in the best way to keep them moving on, build the companies that they want to build. So yeah, sorry, long-winded answer, but I think it's a transition and it's a dynamic period, right, where a lot changes for the founder, and it's very specific on a case-by-case basis.
Thanks. And I guess what you touched upon with Jeremy. I spoke with Jessica, who's also part of the Hatch team, and she said she goes over for the SEIS and EIS fund in total. You guys have been through 1,000 companies who have applied. What's maybe the single biggest red flag that makes you filter out those companies, Jeremy?
I think things are never as simple as that, to be honest. Yeah. I can't say there's one thing. I think a lot of the things that Andrew, Pauline, and Sam have mentioned are all things that we come across as well. I guess just to add to what they've already said, for us, we're very much focused on GTM and sales, and that's where we support founders. And part of that support means that we tend to get quite tend to get our hands dirty, to be honest with you, from building qualification frameworks to doing pipeline management to building email sequences. But a lot of the time that means that with founders, unless you've been an SDR, BDR, BDM before, you haven't done a lot of that. And so you need to be prepared to listen. And when we have a conversation with a founder, if they're doing far more talking than they are listening, and to be fair, it's a pitch, they should be pitching. But there is a balance. Firstly, we appreciate when founders are great listeners, so we can advise them. And typically on that initial call, towards the end of it, or even during the conversation, I might just drop some nuggets of advice from experiences that I've had with other portfolio companies or other companies I've come across in the same sector. And I just evaluate how receptive they are to that. On top of that, I also just evaluate, are they verbose? Because ultimately what I'm trying to understand is their clarity of thought. Oftentimes, if people talk too much, it's a sign that they aren't so clear on what they're thinking about. And that's important because at pre-seed, you've got a certain amount of time, normally 12 months, maybe a bit more, to execute. And time is money. A lot of the time, it's less than 12 months. And so every second, every minute matters. And so you need to be able to say, right, this is what we're focused on for the first 6 months. This is what we're going to be focused on for the next 3 months. And you need to be able to make that decision, as well as also listen to advice. But ultimately, you need to be able to make that decision. And to be able to make that decision, you need to have a good understanding of what your options are, and then make that decision.
Okay, thank you. And I guess we go back to maybe a bit more specific questions, and maybe starting with you, Pauline. What advice would you give to women entrepreneurs who are looking to raise early stage capital but are struggling to find the right investors?
Sure. I mean, listening to the pod, what we've just spoken about, take some notes as to what investors look for and what are the red flags. I think if you've been fundraising for a while, just first of all, understand that the market is very tough at the moment. You are part of the 2% who gets funding if you're, if you have an all-female founder team. So from the get-go, it is just more difficult for you. So don't, keep going and, take on feedback, ask for feedback from investors, direct feedback, not, oh, it's just not right for me because of some generic reason. Specific feedback will really help you, and then work that feedback and reiterate your business or your deck. Not saying to completely overhaul your business, but do have a think about how your business or your idea, your problem, and your solution is relevant right now. Because if you're at an early stage, you're looking to raise a pre-seed or seed, and you may not have a product yet, you need to be able to commercialize it in basically, 12 months or 18 months. And if the market conditions aren't right for that right now, investors aren't going to be interested. The next thing is to have a look at how you're reaching out to investors. Are you reaching out to the right type? So in terms of stage, vertical, industry, geography, there's no point in going to Jeremy with, like a growth stage business. So just understand who you're talking to. And in terms of a pitch deck, I've seen lots and lots of pitch deck, as have everyone else on this panel. So how do you grab the investor's attention? Pitch decks I've seen sometimes they go up to 30 pages, and I really don't read those 30-page decks. Shouldn't really be more than 17 slides, maybe a little bit less if it's just kind of a deck to get an intro. You can have a longer deck that you may have in kind of the data room later on. And I find that decks are too wordy, so just words everywhere, or really distracting pictures everywhere. That is not something that is too appealing. I can go on all day about the specific of pitch deck, but there are loads of literature out there and lots of guides out there. So just make sure your pitch deck is on point. In terms of reaching out to investors, a warm referral is much better than a cold emailing or LinkedIn. So reach out to your personal network, angels and investors who have invested into your business. They may have a huge network, or at least know someone who can introduce you to the investor that you want to reach out to. Have a target list of investors. So do your research and target kind of your tier one investors. By tier one, I don't mean tier one as in size, but tier one investors that you think would really share your vision and really be able to help you grow and scale your business. And this is, I guess, a very female specific problem. 90% of investors at the IC level, or those who are in a decision-making capacity, are men. And men and women just have different lived-in experiences. So if your problem that you're trying to solve is very female specific, it may be more effective to reach out to, if there is a female investor within the team, even if they're a little bit more junior, who can then understand your problem and your solution and be an advocate of your business, who will then take it up to a higher level at the IC level. So as an example, we were speaking to a family office about a product that was doing very well. It was a Series B. We were raising a Series B. They had amazing traction. It was targeting the menopausal market, which is a huge market. I think it was 1 in 7 people on this earth at any given point in time is going through menopause. When it reached kind of the IC/principal level, the principal asked, "What's a hot flush?" So, just knowing which investor to talk to who would actually understand and appreciate the problem that you're trying to solve would be very helpful. So that's kind of my tips for female founders.
Thanks, Pauline. Thank you very much for those insights. I guess moving on to you, Sam. What do you think is the best value add a VC can bring to an early stage startup?
A fun question, because most VCs like to look. Even Jeremy lent in then. He was like, "Oh, here we go. What's he going to say?" Okay, so we stripped this down. We thought about this at length at HP, and what we did was we came up with this thing called the entrepreneur hierarchy of needs, right? the foundational element of that entrepreneur hierarchy of needs is money, access to capital, right, to keep the business moving on. So whether you're deploying a pre-seed, seed, whatever it may be, the capital can come from internally, from kind of growth funds and late stage funds, or its connections to other funds out there, the ability to syndicate deals, the ability to bring angels in, etc., etc. From that, the next one up, and I'm just going to roll through them because it's easy. The next one up from that was literally, we just wrote, don't be an arse. So actually how you interact with founders, that's a massive value add. And I think VC is becoming highly commoditized, and we're seeing more and more kind of solo GPs pop up, more and more small micro funds pop up, and actually VCs now need to think about the product at which we're offering founders, and part of that is actually just being nice, not being a dickhead, responding to emails, actually giving feedback, all of those things that are much easier said than done. Trust me, when your inbox is full, your LinkedIn is full, your WhatsApp is full, right? It's hard, but actually, taking the time to try and do that and actually remember that we are here to serve founders fundamentally. Then up from that, we talk about operational value add. Operational value add can come in the form of, helping make a key hire, helping unlock a door for a key client, a key customer, or it could be something as simple as actually reworking, a financial model, or bringing in someone to actually help with marketing. So often we find that operational value add can come from external sources outside of the fund. First and foremost, whether we think that X founders make better VCs or not, that's a big debate, but ultimately we're all capital allocators. That's our job. So we need to find the best assets to invest in. There are a number of ways to influence the quality of that asset, but that's our role, right? So, not everyone knows in a VC space how to build good marketing plans or strategies or good hiring processes. And that's where we kind of defer to external people to help. And then right at the top of the pyramid, you get to what we call strategic value add. Now, strategic value add is, sitting on boards, helping with the decisions for the company. Should we expand into these new markets? Should we be looking at pivoting the product entirely? Is there an adjacent market opportunity that we should be chasing? From a strategy, from a fundraising strategy, how does that work? And these are things that when you start getting further down the road, the quality of your board members, particularly, I'm saying this from a founder perspective, the quality of board members, the quality of the mentors, the quality of the people you surround yourselves with, even in your other founder circles, can kind of contribute towards that. But as a VC, we look at that as the kind of highest piece of value add that you can bring. And it's probably the piece that you spend the least amount of time on with a founder, but the most amount of time actually thinking about when you're away from those kind of conversations. So that's just simply how we try and break it down. I would be lying if I said we get it right with every company. I'm not going to lie, right? It's very hard to do that because it requires time, it requires good communication from both parties, and it also requires accountability from both parties as well. It's an ongoing thing that you have to invest in. I think more and more VCs are getting better at it now. Us included, and all the everyone else here on the panel, at really defining what the core kind of value add that you can bring and having your edge. And when we get to that really commoditized space within VC, that will become more and more important. So that's kind of how we look at it, and I think how we like to demonstrate it here at Handbrake Perks. One of my favorite questions is always asking founders, okay, who's the ideal investor for you? And more often than not, founders don't really have a clear idea of what it is. It's just, okay, I want money right now and I'm going to go. But then some founders turn around and they say, no, we really need help with knowing how to do B2B sales and fintech. And you think, okay, fair enough. Is that something that we can actually help with? Well, yes or no. So yeah, that's how we look at it.
Fantastic. Thank you. Thanks. Jeremy, I guess coming to you next. Again, very different question. How, Hatch, how do you balance the potential tax benefits of EIS, SEIS investment with the risks associated with early stage startups?
Not a tough question. Where you're getting these from? Look, from a deployment perspective, we don't actually. We have SEIS, CIS funds, but we also have institutional money as well. and we look at all deployment in the same way. SCIS or EIS only really comes into play for our underlying investors, and that's a separate side to the business. But we look at every company in the same way. So for us, our target is 10x return of our entire fund. So every company we invest in, we actually, because of the power laws of VC, evaluate each company's propensity to return the entire fund. So we look at every deal as though it needs to return the entire fund plus also 10x it. So we'd only make an investment if we found that to be true. And in order to do that, we break it down, and that's, I guess, the Hatch model. And I said before that we invest in people that are solving pains in the present for a defined buyer. It's only pains in the present. I mean, you can be creating an opportunity, you can be solving pains in the future, but the only thing that we really invest in is pains in the present. And then we focus exclusively on GTM, and we leverage our internal resource. So we bring in external resources, mainly people who were first SDR hires at companies that are now doing 10 million plus of ARR. And we bring them in on a very results-based agreement, where, for example, there could be a founder that needs some support on, I don't know, implementing qualification frameworks, because at the moment they've got 100 leads in their pipeline. Some are enterprise, some are mid-market, some are SME. They don't know who the economic buyer is within the organizations. They don't know what the procurement process looks like. They don't know what the timelines are to conversion. And so we just need someone to step in there 4 hours, teach them how to qualify leads, and then also start qualifying the leads in the pipeline. Going back to your question though, we look at all deals in the same way. We target 10x return per deal that we invest in, and we don't really take SCIS or EIS into account.
Okay, great, thank you. And I guess coming to you next, Andrew, what role, and this is again a very wide question, especially considering the circumstances, what role do you see VC and early stage investment playing in strengthening and rebuilding the Ukrainian economy in the aftermath of the conflict? And again, how do you balance the potential for financial returns with a desire to contribute to positive social impact?
Sure. Yeah, I think it's going to be playing even a bigger role, because what we have here, and for Ukraine, it's kind of perfect storm, right? There's a global crisis, we have the war, and after the war, basically, there will be a lot of IT professionals out of the door, and there's even bigger ways of layoffs coming, right? So there will be actually the companies early stage that will be raising money, will be actually hiring people, will be playing a big, kind of very big role in this. And as we see, we can help this. And in terms of balancing the risks with kind of investing and kind of doing a good thing, right? So at least for our fund, we did a special, and it was a part of the pitch to our LPs, and also how we negotiate with the founders to tell them, hey, if you want money with us and if you want to grow, we're going to do the KPIs and tranche financing. So this way we actually can add extra safety feature on our side, because everything can happen, and this is what our investors also like. So this way we're setting up with them the roadmap. We're saying, hey, usually when we invest, we decide that we're going to help them to get to the next level, basically raising the next round. So we break down this road from what's needed to raise the next round into KPIs in usually like quarters, right? And then it's product metrics, and then it's also in terms of the team who have to be hired, will have to be developed in terms of the product. And basically we log them to how much money we need to each of these steps to get there. And this way we add this extra feature and motivation for the founders kind of to get there. And this is also important for us because, right, it's our money. We don't want to lose this money. So we actually helping we're working with the founders to help them to get there to the next stage and unlock next level. So, but this is going to be built big in terms of rebuilding of Ukraine. For instance, in Ukraine now we have a big splash of dual purpose startups, military tech, cybersecurity, also like the drone industry. I believe Ukraine is going to be now #1 in the world. We have already more than 200 companies doing all sorts of drones, from assault drones, from like the radio, defense drones, like so many things that cannot be not even spoken, right? And also a lot of like machines for training the military, from A-10s, the Thunderbolt, the jets, to F-16, to, I have the cool startup that it's teaching people how to practice drills, like with the guns. And they're like, both founders are actually in the military, and they have now with over 15,000 users. And it's now free. It's actually one of the potential targets for our fund. But there's going to be big input, and they're going to be hiring more and more. And of course, this is bringing also like cash and direct investments into the country, because they hire people and they provide jobs. So this for rebuilding Ukraine, it's going to be very important. And like Ukrainian ecosystem was growing 40% year over the year, right? So we have 10 unicorns. Ukrainians are among top 10 unicorn founders in the US. So this is going to help Ukraine to kind of become one of the like new economic tigers, right? So it's going to be like new one of the fastest developing economies, and that's also what drives me to kind of to put my help into help my country succeed.
Fantastic. Thank you very much. Just being conscious of times, I think we'll leave just have two more questions, and that will be for everyone on the panel. So maybe starting with you, Sam, for this one. If you look out over the next 5 years or 10 years, what sectors or specific technologies are you most excited about?
Oh, Hugo, why did you pick me? Great. What am I most excited about? Okay, I think we're very bullish on cloud computing and the power of quantum computing. And I know that might be quite a large hardware play and hardware pieces of the puzzle that need to fall in place for that to actually come out. But I think especially in the financial services sector, and even in cybersecurity more specifically, quantum computing is going to be incredibly powerful. We are already seeing a wave of generative AI and applied AI in a way that I don't think has ever been put into the market and embedded before, which is quite exciting. I will caveat that with saying I think we're now seeing more startups that are building application layers of AI rather than actually deep technical innovation in AI and ML, which is exciting for us. And I also look towards climate tech as well. Our view at Hambro Perks is that we do actually need more hardware, more things in the ground, more things in the air to actually solve this problem. We are working with specific LPs. We also have a Series B growth fund specifically on environmental technologies. They are far more intelligent than I am and can give you a much better breakdown of the detailed technologies that they're looking for. But one thing I will say is that we're not adverse to innovations in hardware to actually enable us to kind of tackle the climate crisis. So yeah, I guess those would be the kind of three big areas that we're specifically focused on. But we span a wide range of different verticals, right? So things are always going to be popping up.
Great, thanks. Now, Pauline, maybe to you. What technologies or specific sectors are you most interested in?
Yeah, sure. So my favorite is actually in health tech. And when I say health tech, it could mean a lot of things. It could mean life sciences all the way to platforms that connects, health services to customers, to reduce cost and give access, and kind of everything else in between. And within health tech as well, there is that quantum computing as well as using AI to basically diagnose potentially diseases before a doctor can, and basically anything that would reduce the current workload to our healthcare system is also very valuable and very much needed. And I think that's been really highlighted, by COVID. I'm sure there'll be another COVID or something similar, around the corner. And I hope that by making investments into this sector, that would be able to prevent another full-blown kind of global meltdown. So health tech is something that I'm really interested in. The other thing that I'm really interested in as well is climate tech. Basically, I think the commonality between health tech and climate tech is that it is making our lives a better place, and it's actually saving lives. So when it comes to climate tech, I agree. Then it's great to see that climate tech investors don't shy away from investing into hardware, which most generalist VCs would kind of shy away from, just because of how capital intensive it is, and in terms of the scalability of that particular hardware, because there is limited capacity to hardware. And recently I joined the Reasonable Impact program as a mentor, and I just met so many different amazing founders with really great ideas to help reduce the carbon emission. So yeah, really looking forward to see what else comes out of climate tech.
Thank you. I guess coming on to you next, Jeremy. What are you most excited about?
A couple of Christmases ago, I actually tried to look at different industries and sort of pick a few that I was really interested in, and tried to predict what was going to happen. And I realized there were far too many variables for me to even try to calculate what I think is going to happen next. At that point, I realized that's not my job. Personally, my job is to back the founders who are telling me what the future is. And Hatch recently is actually completely repositioned from being that type of fund to now being a fund that is completely strategic. We just focus on, like I said, people solving pains in the present, and it's B2B SaaS. So we leave all the big thinking to the founders. We allow founders to come and tell us the story, tell us the future, tell us the pain that the individual within that organization is facing, tell us the size of the budget, tell us the size of the market. So we're far more reactive. I think over time, hopefully, when we have a big contingent of companies that are all focused in one area, we'll be in a position to say, right, based off of what we're seeing, this is what the future looks like. But as of now, because we're pre-seed, and we sort of invest in everything from data to healthcare to pretty much B2B SaaS, it spans so many different industries. It's hard to say, this is what I think the future of X looks like. So yeah, very, very responsive. But I do have industry preferences. Anything slightly technical, data infrastructure. Also, my wife is pregnant, so I'm very interested in femtech. This is the first time I've actually had proximity to, I guess, this process. And I have so much empathy for women that go through this. And I think there's a lot of opportunity to help women as well. See, I'm on the eye for my eyes are open for femtech and people that are building solutions in and around the problems that women are facing.
Fantastic, thank you. I guess Andrew, you talked about drones. Is that the most exciting for you, or what would you say is the most exciting for you?
So there is a next level. So for me, it's actually what I'm looking at. It's longevity on one hand side, and also space technology. So because anyhow we have to live on this planet, and kind of the quality of life is important, right? So that's why the longevity. And I have friends from R42 fund, so they actually that's a longevity focused fund, and I'm just picking up things from them. But in terms of the space tech, I think in the end of the day we're gonna still overcrowd the planet and kind of trying to move to be interstellar kind of or interplanet species. So for me, like the next generations will be there, and even now, like the satellites are helping us to do intelligence and Russian positions, right, and help us. So that's already in our lives. So, and there will be more. Everything will start going to space. So I'm also start looking into that direction as well.
Great.
And we have Ukrainian guy who is also founder of Firefly. It's also a unicorn company that was overtaken by U.S. government, but it's also like the aerospace is kind of coming back big time to Ukraine.
Great, thank you. I guess we're over time. Do we have time for one more question? Yeah.
Depends on who you ask.
all
what the
of
question
you.
is.
all of you,
target Sam again.
two sentences, 2-3 sentences each. What's the single biggest piece of advice you'd give to someone who wants to start a company? I guess Sam, you can go first.
Thank you, Pauline. The single biggest piece of advice. I would say build with your community, in your community in a very public way, and build the business that you want to create rather than building the business you think a venture capitalist wants to back.
Great, thanks.
That's it.
Thanks. Pauline?
Mine's more, I guess, at the beginning stages of when you're thinking about starting a company, you know, because we are talking about early stage investing, is really think about what your personal goals are, why you're starting a company, and what are your expectations. You know, for me, starting my business, I was in a lucky position to have personal runway. And, you know, I know Jeremy was describing how, you know, the founders of Hatch, you know, went through all this kind of ups and downs and all these challenges, and was very much very, very resilient. And I agree with that. I think that resilience is definitely very important, but think about what you want out of this whole journey, because it's not going to be easy. It's not, you know, a 1 or 2 year project. It's a 5 to 10 to 15 years project. It now takes 14 years for a startup to IPO on average. So it's a very long journey ahead of you. So think clearly as to what you're trying to get out of this.
Okay, thank you. Jeremy?
To echo what Pauline said, I think just know what you want out of it. As a previous VC-backed founder, now I'm actually just building a chicken farm on the side of my day-to-day role, because I realized, well, actually, I don't want the glitz and glamour of raising millions and I guess the expectations that come with that. Actually, you know, a chicken farm is very profitable, and you know, it helps pay the bills. But my one bit of advice would be to solution sell. I think I come across so many founders that start selling the product to me, or start pitching the product, as opposed to firstly, just before you even think about the solution, just think about the pain. Who's experiencing the pain? What do they look like? Where are they based? How much money do they have? What are their motivations? And then build a solution around those pain points. So literally start building a product that maps directly to each pain point, and then go from there, as opposed to just saying, I'm going to do X, Y, and Z, and then try to find a pain or a customer after you've built the product.
Great, thanks. And finally, Andrew?
Yeah, my answer will be simple. Don't do it, man. Literally, unless you have what it takes, unless you have you build your support system, right? People who will support you in your path. If you save some money, at least for 1 year, better for 2 years runtime, right? Unless you build connections with VCs already, unless you believe in what you do, unless you have experience in this. If those all doesn't tick, don't do it, man, because you're gonna suffer.
Great. Well, you know, this brings us to the end of today's panel. I wanted to thank each of you for taking the time. So yeah, thank you guys.
Yeah,
Thanks for having us,
Thank you,
Hugo.
Hugo.
Thanks for having us.
Thank you.